What should I pay for this company? We're going to talk about valuations and how you determine the sales price of a company that you want to buy. Now, there are a couple different ways to value a company. And the method that we are going to focus on is related to one thing, and that is income. Now, you can value a company using its assets, or you can maybe even look at the market comparables. But in this video, because we're focusing on small businesses, typically selling for less than $10 million, we're going to focus on income-based valuations. So how do you determine income? Income is typically revenue coming in, the money coming in the door, minus the expenses going out. There's really two different metrics that people use to determine what the income of a company is. These two metrics are called SDE, or seller's discretionary earnings, or EBITDA, earnings before interest, tax, depreciation, and amortization. The difference as to when you would use SDE versus EBITDA to determine the earnings of company is whether or not that company is owner operated, meaning the person that owns it also on a day-to-day basis works on the operations and maybe runs the company. And in those cases, you would typically use SDE. In other cases where the company is maybe hired on a CEO or a manager to run the day-to-day operations, you would use EBITDA. So what is the difference and how do you calculate both SDE and EBITDA? They're both very similar in that you are just taking the revenue coming in minus the expenses and you add back certain things. In the case of EBITDA, you add back things like interest, tax, depreciation, amortization. You do the same thing with SDE, but you also add back your owner's compensation. Say I make $200,000 a year. I'm going to add that back into the company's earnings. With SDE, you're also going to see a lot more liberal use of add backs. These are things like maybe I spent $60,000 on phone and internet bills for my entire family, and I put that underneath the business. Yeah, maybe that made sense for your tax purposes to add those as business deductions. However, it took away from the total earnings of your company. So in the case of SDE, you're going to see a lot of owners try to add back a lot of stuff like family vacations, posed as business trips back into the earnings of the company so that they will get a higher valuation. Now you take both either your SDE or your EBITDA and you add a multiplier. These are typically industry standards. Maybe 3 times multiplier is what we typically see, but multipliers can go as high as 6, 7, 8 times multipliers, really as you get into industries like finance or healthcare. Really, your industry sector may determine a lot in terms of what range of multiplier you're going to use. Your company's size and its professionalism will also play into what side of that range your company falls in at. Let's summarize with an example. Let's say I make $1 million in my company in terms of earnings. I add back in my $200,000 salary. I add in $50,000 for my phone bill. And I say, those are add backs. Those are not recurring expenses. You don't need that. So therefore that should be putting as part of my SDE. Now you take that $1.25 million and you say, I'm going to add a 3 times multiplier on this because that's typically the standard in my size of business as well as my industry. So 3 times 1.25 is $3.75 million. Now, should you go pay $3.75 million for this company? You could. Some could say this is fair market value. However, you could also argue as the buyer that this $50,000 that you're putting back into the company because of this phone bill, the phone bill actually is important and it's something that's recurring. So therefore, I'm not going to add that back in. Your earnings is really 1.2 million. And maybe I don't believe in the 3x multiplier because, hey, your systems are all kind of shoddy. There's nothing written down. Anybody off the street coming in couldn't really run this company. It's just not as professional as it should be. So maybe I'm going to give you a 2.5 multiplier on a 1.2 million SDE. You see how you can sometimes negotiate the price down based off what you believe is applicable and valid add back, as well as the professionalism of the company. Now, as a business owner, you want to think about a couple of things if you want to increase the value of your company, such as increase the amount of revenue that you can bring in, maybe decrease the amount of expenses that you're using for tax deduction purposes. And you can start to think about what will justify your company being valued at the higher end of the multiplier range, such as professionalism of your processes. Can you write everything down? Can you fix the leadership structure in the organization so that everything runs like butter? Another thing you can think about is the diversity of your customer base. Is all of your revenue coming from maybe two or three customers, which makes it much more risky to take this on in case those two or three leave? You can justify being at the higher end of the scale if you have a diversity of customer base, you have professional operations put together. You can also think about intellectual property, as in what is owned by you and is unique to your company that you've created. So bottom line is the market will determine the sales price. You can run the math all you want, but that is typically a baseline. And then you start to negotiate through the difference of your company versus all the other companies in your industry. So I hope that helps you understand that sales prices aren't just pulled out of thin air, they're calculated and there's a fundamental base. And you as a business owner can understand what metrics drive your valuation up. And you as a buyer can understand that there are concepts here that can be negotiated. Let's buy a business.